Hello and welcome to the 2026 market forecast. Today is January 28th, and I am Ricky Walters.
He's the mortgage wise guy, wise guy.
So, this is the forecast for mortgage rates as well as home values going into 2026. And before we do that, we want to acknowledge it would be great to have a crystal ball, wouldn't it? To be able to see what's going on in the future. But we don't have one of those. What we do have is a guy named Barry Habib with MBS Highway, who was honored with his fourth Crystal Ball of the Year award last year. It's awarded by Fannie Mae and Pulsenomics. Why do they award it? For most accurately predicting home prices as well as mortgage rates at the beginning of the year. Barry has won four out of the last eight. You see those there in the picture. And no one else has won more than once out of over 100 industry experts that are polled for these predictions. So, first of all, let's recap what we said was going to happen last year and see how close we came. All right. First of all, the 10-year Treasury yield, the benchmark for mortgage rates, was forecast at 3.8%. At the time, it was at the high fours, so it was a pretty bold prediction. And we got down to 3.89, very close. The 30-year fixed rate low target, we set at 5.75 to 6%. And we actually hit 6.1% was the low, although the first week of January, we actually hit in the high fives for a few moments, couple days there, and then it went up a little again above 6%. But we were a week off of hitting that low target that was set for the year. The mortgage spread, what is the mortgage spread? That's the difference between the 10-year Treasury yield and the average 30-year fixed mortgage rate. When we started the year, it was at 2.8 and we predicted 2.25. It actually came down a bit lower than that, but pretty much right spot on to the prediction. Home price appreciation was predicted at 3.5%. The only aggregator so far that's given us the yearly statistics nationally was Redfin at 2.6. So a little bit of a miss there. And the unemployment rate was forecast at 4.5, and the actual rate came in at 4.56. No Fed members at the time at the beginning of the year thought it would go beyond or above 4.3%. So that was very accurate. And the smartest, supposedly, economists in the world were not predicting what we predicted and were correct about. So we talk about the Fed a lot. Why? Because the Fed, their policies impact so closely, not exactly, but very closely, what happens with mortgage rates. And they have a dual mandate. Their dual mandate is one, keeping inflation low. They want a target of 2.0% on core PCE. PCE stands for personal consumption expenditures. And the core strips out food and energy, which is what the Fed thinks that they can influence. And so that's their target. Their second mandate is to keep employment, maximum employment, and avoid recession from job losses and high unemployment. Okay, well, just today, the Fed held interest rates steady for the first time since July of last year. That was updated this afternoon. And hot off the press this afternoon, we see that the statement in highlights is the unemployment rate has been broadly stable and inflation remains somewhat elevated. Is that true? Well, we're going to find out in some data that we take a look at in just a moment. So, first of all, let's look at inflation since that's one of the things that the Fed looks at. Love this graphic because it's a picture of too many dollars chasing too few goods. That is exactly what inflation is. And so, our current reading on inflation for PCE, personal consumption expenditures, is 2.8 on both headline and core. And shelter is a pretty large component of the PCE inflation report. There's another inflation report called CPI, Consumer Price Index, and the shelter component makes up almost 50% of the core on CPI, so a huge portion of it. We're looking at now the shelter component, and it's trending lower, but the way that it's measured by the BLS, which is the uh, government organization that measures both inflation as well as the job data. BLS stands for Bureau of Labor Statistics. They look back in the past year, and they average looking back instead of looking forward, which to me is a very foolish way to do it. But if you look at actual new rents and actual renewals, the average for looking at the housing component is much lower than what the BLS is measuring. And if that were used in this report to calculate the actual overall inflation, our inflation would be much lower than where it is. Truflation actually looks at 10 million data points, and they said just 3 weeks ago that we're at 205, and they updated it this week, and they said for the PCE measure of inflation, it's really at 1.39, lower than the Fed's target, and for CPI, it's 1.16, much lower than the Fed's target. So these are all very positive um, readings on inflation, even though the Fed is saying that inflation is persistently high. Elevated is what I believe the word was that Fed Chair Powell used. So our forecast is for PCE core to come down from 2.8 to 2.5. Let me show you that here in a second. And we believe that these numbers are overstated because of tariffs, which is a one-time adjustment. Everyone says that, of 0.3%. The shelter lag that we just talked about in portfolio management. If you have any money in the stock market or mutual funds, you're paying a money manager, and as your money grows, you're paying more because your money is growing. But that's not really inflation. You're not paying uh, for something except you're getting higher returns on your investment. That really shouldn't be a measurement in inflation. So if we took those out, we would already be below the Fed's target. But using their methodology and their way of measuring it, we're going to say the forecast is 2.5% later this year, down from currently 2.8. Let's look at forecast for unemployment now. It's harder to find a job if you've been let go. How do we know? Because continuing claims have been increasing since the middle of last year. You can see the arrow and the data point, and that is the demand for jobs. What about the supply of jobs? Well, the supply of jobs has been decreasing at the same time that demand for jobs has gone up from middle of 2022 till the end of last year. You can see job openings decreasing, and that's overstated also because they count the jobs in Kansas, in Nebraska, in Nevada, in California that may be double, triple, quadruple counted because you can work from home on many of these jobs. So that number is likely between 1 to 1.1 and 2 million is probably where we are on that number. ADP private payrolls, I think it's a much more accurate measurement than the BLS. And we see that 4 of the last 7 months, we've only had an average of 10,000 jobs gained in the last 7 months, with 4 of those 7 months showing negative job gains or job losses, actually. So the BLS shows something not that dissimilar. You can see the decrease in jobs over time, and 3 of the last 6 months, as measured even by the BLS, we saw job losses. But it's still overstated. What do we mean it's overstated? Well, this is the January job report that came out for December, always comes out the month after. And we found out that although they were projecting 73,000 estimated jobs, only 50,000 were created, and that will likely be revised lower. How do I know? Because the revisions for the previous 2 months also were lower for November and October, a whopping about 60,000 jobs combined lower than the previous 2 months initial number that came out. So this happens every month. And if we look back for the year, the initial numbers that come out from the BLS, or I call it the BS, is 1.9 million. And after the two revisions, it's down 400,000 roughly from what they originally said over that period. And then they put out the BLS also generates what's called the QCEW, or the Quarterly Census of Employment and Wages. And they said, well, 75% of those jobs, whether from the initial or the final numbers, just take the middle point there, 75% of those jobs were never created. Why is that? Well, it's because there's this birth death model of small businesses, and they're trying to estimate with a computer program how many jobs were created when this company, this small business, was started or this small business closed. And those numbers are just horrible. This methodology is decades old, and they need to be looking using AI and other methodologies that's much more accurate, but they haven't been doing that and continue to use the old, outdated methodology. The unemployment rate has gone up since the middle of last year pretty dramatically, as you can see. And the labor market remains solid, I believe, is what Powell said in his statement today. Doesn't look solid to me. And we believe that the unemployment rate, even though it's at 4.4, 4.5 right now, it will be increasing by the end of the year to 4.8%. So the forecast now for the Fed, now that we know what they're looking at and the projections for both unemployment and inflation, let's look and see what the Fed funds relationship is to longer term rates, like a 30-year fixed. The lower blue line is the federal funds rate. The red line above it is the 30-year fixed average rate. Now, while they're not always in tandem, they do track very closely. So when the federal funds rate is lowered, mortgage rates come down. You can see that over time. They don't always exactly track, but generally they do. So as the Fed would lower rates this coming year, we believe you will see lower mortgage rates to follow. What else is happening? Well, the Fed is changing a number of their members. There's 19 Fed members. There's 12 who vote, and several of them have been recently replaced. President Trump has put what's called doves, who believe that we need to lower the federal funds rate, compared to a hawk who is concerned about inflation getting out of control, and they think we need to keep rates higher for longer. So you can see the composition going into this year, and we're going to get a new Fed chair in May when our current Fed chair terms off in May. All right. Federal funds rate forecast for the end of the year, 2.875. What does that mean? Well, currently it's at 3.625. So that would bring down about 0.75% or 0.75% rate reductions, probably in the second half of this year once we get a new Fed chair. All right, let's do the forecast for actual mortgage rates. That's what everybody wants to know. This happens, picture on the left is Scott Bessent. On the right, that's Barry Habib again, Mr. Crystal Ball. And Scott Bessent says our target for the 10-year is to get it to 3.9. Currently, it's at 4.2-ish. And what will influence mortgage rates coming down? Well, the one that's working against us the most is additional debt. We don't have a balanced budget. We're borrowing more and so to borrow more, we have to issue more debt. That's adding more supply. That's inflationary. That's the one thing that's kind of working against us in getting lower mortgage rates. Fannie Freddie, it was announced just 2 weeks ago that they were going to buy 200 billion in mortgage-backed securities. And that was just increased this week from 200 billion to 450 billion. So that's very good news for the direction of lower mortgage rates. Terming debt shorter, meaning that the government's going to issue more shorter term maturity debt instead of the longer term. That'll shrink the supply on the long end of the curve and bring mortgage rates down since they're more looking at the long end of the curve. Also, the Fed is buying 40 billion a month in short-term treasuries. That's going to also help in bringing mortgage rates lower. And then lastly, Scott Bessent, our Treasury Secretary, wants to have banks invest in treasuries and reduce the reserve requirements, bringing more liquidity and bringing the effect of bringing mortgage rates lower with that as well, with that policy. Here's the targets that Barry Habib has, a couple other economists, very famous, Katie Stockton, Lacey Hunt, even lower. And so if we look at where the 10-year Treasury is and we add this spread between the 10-year Treasury and where mortgage rates are, historically that spread has been roughly 1.5 to 2%. It has really spiked high coming out of COVID, as high as 2.6%. That was one of the predictions last year that Barry nailed in bringing that lower to 2.2. and it even came lower than that. And currently, it's now shrunk to 2.12, and we believe it's going to shrink even further. So our forecast is the 10-year Treasury yield to be at 3.8, that mortgage spread narrowing from 2.1, another 20 basis points to 1.9. You add those two together, that's our projection for the 30-year fixed low rate for the year. That's about a 0.5% lower than the market is currently. If we get that, imagine how many more buyers are going to jump in and want to buy a home. So get ready for that activity and let your buyers know that if you're waiting, you're going to have more competition as rates come lower this year. So this is the forecast from Fannie Mae, NAR, Zillow, Wells Fargo, Realtor.com, all these other organizations. The only one that's really predicting below 6% is Barry and MBS Highway. And then, of course, Fannie Mae is just below 6% as well. That's kind of interesting. Why? Because Fannie Mae lowered their target after Barry presented all this information that I'm presenting to you today to the board at Fannie Mae, and they said, we agree we need to lower our projection for mortgage rates going into 2026. There's going to be a lot of refi opportunities as mortgage rates come lower. That's going to help people with their cash flow, which means they can buy investment properties and cause more people to come to you with opportunities to buy and sell their homes. You can see these opportunities after there's been higher rates, the red, I believe that's red, and then these shaded areas after rates have been high. Every every several months, there's an opportunity to lower the rate, and that's why we call it marry the home and date the rate. That's what we tell anyone who's looking to buy a home. You don't have to get stuck with a high rate. You can refinance that rate lower, often at no cost with a lender credit. That's my favorite type of refinance to help people do. It's free money, lower your rate, lower your payment for free. So let's now look at the forecast for real estate for 2026. And we can see this is the demand, and this is a national demand across the country for the year. 1.8 million households are formed in the last several years on average. What does that mean? It means mom and dad are having a kid. They can't live with their parents anymore. They can't live in the apartment anymore. They need to form a house, buy a home. And had these, how come it dropped off at the end of 2025, the last half? I believe that is pent up demand and they didn't go anywhere. They still need to buy a house, but the affordability and the uncertainty question kind of caused people to take a step back in the second half of 2025, especially with some job uncertainty up there around. I think that's probably the biggest factor why that people are concerned about their jobs. And housing starts, the supply end to go with the demand is also coming down. So lower demand, lower supply, but I believe that demand will pick up for sure as interest rates come lower. You can see the inverse relationship very clearly here that as interest rates do come down and we see a dip in interest rates, there's a spike in pending home sales. The opposite is true when interest rates spike, there's a dip in pending home sales, and that's pretty much the case. Every one of these data points, you're going to see the divergence between interest rates and pending home sales. So here's the forecast from all these different organizations, Realtor.com, Pulseonomics, Zillow, Fannie Mae, NAR. If you average them all, roughly in the low 2% range for national home appreciation, and MBS Highway and I are predicting 3.5% for the year. So here's our forecast just to give a quick overview. Currently, unemployment's at 4.4, believe that's going to go up to 4.8. Core PCE inflation currently at 2.8 will reduce and come down to 2.5. Both of those things are very much going to push the Fed to lower the federal funds rate. So that's why I believe instead of two rate cuts of 0.25%, we will see three, possibly more by the end of this year. Mortgage rate low, currently at 6.15. It's going to come down almost 0.5%. What will that do to bringing buyers back into the market and pushing up home prices? I think you know the answer. And home price appreciation currently nationally at 2.6. Believe that's going to go up to 3.5% for the year in 2026. All right. I always like this slide because people need to know that the way to build wealth and generational wealth for your family, if you don't have stock options in a company that's just IPO'd on the stock market, the path to wealth and generational wealth is home ownership. 40 times greater net worth for homeowners compared to those who rent. People are scared. That's why I present all this information and data. Feel like the market's moving too fast, that we might be pushing them out of their comfort zone. So they need to see this data. They need to be empowered to make their own decisions and not rely on emotions, opinions, conjecture, or bait click negative headlines that the media puts out so often just to get clicks to their website. Is there any problem with being pre-approved? Well, I think there is. A lot of people think that's the best type of person to work with if you're a realtor. Well, the problem is they only think they can buy. Why is that a problem? Well, how many pre-approved buyers, if you're a realtor, have you invested your time with that never bought a home or took 1, 2, 3 years or longer to buy a home because they only thought that they could buy a house? We want them to move from thinking that you can buy to thinking that you should buy, and even most importantly, moving to knowing that you must buy. That knowing you must buy will motivate someone to stretch, to do what's needed. And we all know from those who've bought a home, you have to stretch a little bit and it's uncomfortable initially. You're making a big, huge financial decision, but that 40 times the net worth of those who own compared to those who don't is a very, very important and compelling statistic. So I am Ricky Walters, your mortgage wise guy. If you have questions, you can message me. And I thank you so much for watching and listening to my projection for 2026.
He's the mortgage wise guy, wise guy.